Hello and welcome back to the note. It looks as though Goldilocks is still skating along the ice. Goldilocks, for those who don't know, is the term used in markets for when things are not too hot, not too cold, and things hum along nicely. Goldilocks on ice is a situation we've had for many years post-crisis now, where things are cold enough that central banks, led by the Fed, have to keep very easy monetary policy, but not so utterly freezing that the economy collapses. It looks as though, despite speculation to the contrary, it looks as though we continue to be in that Goldilocks on ice environment. Now, the latest data on the economy we received today was European inflation. And as you can see, there is still almost no sign of any inflationary pressure at all in the Eurozone. If you take core inflation, excluding energy prices, it's just ticked up to 1%. The headline number, it has ticked up to 0. Plainly, every reason on this to expect the European Central Bank to intensify its QE bond purchases, as many people already expect. Now, if we move on to the corporate earnings season here in the US, we've had a big week of earnings announcements, and if we take a look at this next chart, this shows you where we headed at the moment, a blended rate of those that have companies that have announced already, plus the existing forecasts. And as you can see, compared to the very negative expectations that we had heading into the quarter on the 1st of October, we have, as is often the case, seen that companies have managed to beat their low bar. At one point, the expectation was that earnings were going to be down as much as 5% year on year. Now that is down to less than 2%. There is a faint chance that earnings might actually just about rise year on year after all. Obviously, everything is dominated by the dreadful results on for energy, which many had expected. You do see some positive surprises there, perhaps particularly in healthcare. However, given how low these earnings growth numbers are, and given that they have been achieved on revenue numbers which are both disappointing compared to expectation and negative, sales are dropping compared to a year ago, this doesn't look like a particularly strong basis for the US stock market. You can only really feel confident about buying stocks on this basis if you don't think rates are going to rise and if you don't think that's going to crowd out earnings multiples. Now, the critical factor or a critical factor for whether rates are going to rise is the international situation. If we take a look at this next chart, you can see this compares emerging market stocks with developed markets, and you can see a serious loss of confidence in emerging markets, which reached a crescendo when concerns were greatest over China back in August. There was a recovery from there, but it's not been a strong recovery, and emerging markets are declining once more. If I was to graph emerging market foreign exchange or industrial metals, also very directly linked to the strength of emerging economies, you would have a similar picture. You can't necessarily say that we are heading towards new lows. We might be in the process of bottoming, but we are certainly not yet in the process of recovering. There is remaining a risk that you could see a resumed crisis in emerging markets, and that would stymie any chance of a rate rise. As for where we head next week we will have another huge week for earnings from the US, the last big week of earnings season, and as it's the first week of the month, we will also have a lot of new economic data. The most important, obviously, as ever, will be the unemployment data for the US at the end of the month. That will have a big effect on expectations for the Fed. But as it stands, as we approach Halloween, Goldilocks stays skating on the ice.